Everyone knows K-pop. Millions of people around the world listen to Korean music every day. Korean dramas dominate streaming platforms, and Korean beauty products are sold almost everywhere. But here's something most people don't know. South Korea is home to some of the world's most successful companies. Samsung, Hyundai, LG, SK Hynix, companies that helped shape entire industries. Yet despite all that success, Korean stocks spent decades trading at lower valuations than many of their global peers. Why? Why would one of the world's most advanced economies trade at a discount? And recently, for the first time in decades, investors have started asking whether that discount should exist at all. To understand why, you first need to understand what makes Korea different. Because investing in Korea isn't quite like investing anywhere else. Most investors know Samsung, but Samsung is only part of a much bigger story. To understand Korea, you need to understand something called a chaebol. Imagine if Apple owned part of Tesla, Tesla owned part of Netflix, Netflix owned part of Nvidia, and somehow the founding family still controlled the entire network. That's not exactly how Korean chaebols work, but it helps explain why foreign investors often find Korea confusing. Samsung, Hyundai, LG, SK. These aren't simply companies. They're vast networks of affiliated businesses built over decades. For generations, they played a central role in transforming Korea from one of the poorest countries in the world into a global industrial power. Today, chaebols remain deeply embedded in Korea's economy. And because of that, they also shape Korea's stock market in ways that often surprise foreign investors. In Korea, you're not always investing in a company. Sometimes you're investing in an ecosystem. But chaebols aren't the only force shaping Korea's market. There's another: millions of ordinary investors. During the pandemic, retail participation exploded. Millions of Koreans opened brokerage accounts and entered the stock market. Many became known as the Donghak ants. The name comes from a 19th century Korean uprising and reflects the idea of ordinary people standing against larger powers. Unlike many Western markets, retail investors play an outsized role in Korea. Individual investors consistently make up the majority of all trading activity. And that creates a unique investing culture. Korean investors even have a special word for highly speculative stocks: jabju, roughly translated, junk stocks. Every market has speculative companies, but the existence of a widely used term like that tells you something important. Korean markets can move fast, narratives spread quickly, and retail sentiment often matters more than foreign investors expect. Remember the question we started with? Why were Korean stocks so cheap for so long? The strange thing is, it wasn't because Korea lacked great companies. It had plenty. Samsung became a global technology giant. Hyundai became one of the world's largest automakers. SK Hynix became one of the most important companies in the AI supply chain. For decades, Korean stocks traded at some of the lowest valuations in the developed world. Even world-class Korean companies were priced well below their global peers. This persistent gap became known as the Korea discount. Some blame corporate governance. Others point to geopolitical risk. Many point to the chaebol system itself. But in many ways, the problem wasn't success. The problem was trust. Trust that minority shareholders would be treated fairly. Trust that management would prioritize shareholder value. Trust that the interests of controlling families and outside investors would remain aligned. Whatever the cause, the result was remarkably consistent. World-class companies, discounted valuations. And that's what makes Korea so fascinating. Because beneath Korea's cultural success lies something many investors overlook: a manufacturing powerhouse. The world sees K-pop. Investors see shipyards. The world sees K-beauty. Investors see semiconductor fabs. The world sees Korean dramas. Investors see battery factories. Unlike many developed economies, Korea remains deeply rooted in manufacturing. And in a world increasingly shaped by technology, supply chains, and geopolitics, many investors believe that matters more than ever. For years, many investors assumed the Korea discount would never disappear. Then something changed. Not overnight, not all at once, but slowly. The conversation started shifting. And recently, a different question has started to emerge. What if the Korea discount isn't permanent? To understand why that question suddenly feels real, it helps to look at another country, Japan. For decades, Japanese equities also traded at depressed valuations despite owning world-class businesses. Then governance reforms began. Companies faced increasing pressure to improve shareholder value. In 2020, Warren Buffett quietly started buying into 5 of Japan's largest trading houses. And in 2024, the Nikkei finally broke its 1989 record, a high that had stood for more than 3 decades. Today, some investors are beginning to ask whether Korea could follow a similar path. Not because Korea suddenly became a great country or suddenly built great companies. It was already both. But because, for the first time, they're questioning whether the discount itself still makes sense. In 2024, the Korean government launched the Corporate Value Up program, an effort to encourage listed companies to improve shareholder returns and corporate governance. Then in 2025, Korea amended its Commercial Act. Remember the trust problem? For decades, investors worried that controlling families and minority shareholders weren't playing the same game. For the first time, corporate directors now owe a duty of loyalty not just to the company, but to its shareholders. This was Korea's attempt to change that. And the market has been anything but quiet. In 2025, the KOSPI was Asia's best-performing market, and in 2026, it crossed 8,000 for the first time in its history. Whether this is a genuine re-rating of Korea or just a boom riding on artificial intelligence is exactly what investors are debating. And none of it is guaranteed. Reforms can stall, markets can reverse. And much of this rally rests on just 2 companies, Samsung and SK Hynix. Together, they now make up nearly half of the entire index. And no one knows how this story ends. But for the first time in decades, one of the oldest assumptions about Korea is being questioned. The assumption that Korea deserves a discount. And markets often begin changing long before everyone notices. Most people know Korea through K-pop, K-dramas, K-beauty, and K-food. But investors see something different, a market shaped by chaebols, driven by passionate retail investors, and standing at what might be a turning point in its history. Whether it is, that's for you to judge. Over the next few videos, we're going to explore that hidden side of Korea, the companies, the industries, and the stories most investors never hear about. The Korea of shipyards, semiconductor fabs, battery factories, and companies most investors have never heard of. Today, the world knows Korea through its culture. One day, investors may know it for something else. Welcome to K-Stock.